You know, something wild has happened in the financial markets over the last few years. And get this, the revolution didn't kick off on Wall Street, it started right here, in the palm of your hand. Millions of everyday people, armed with just their smartphones and some slick trading apps, have stormed the stock market. And their arrival brings up a really fascinating and pretty urgent question.
So what happens when this new army of traders teams up? Whether it's on purpose, through social media, or just by chance, well, they can move markets in some absolutely staggering ways. But does all that power actually, help them? As we're about to find out, the answer is way more complicated than you might think.
Okay, so first things first, we really got to get our heads around just how profoundly the game has changed. The rise of these mobile-first trading platforms has completely redrawn the map of who gets to play in the market.
Think about it. It wasn't that long ago that trading meant dealing with crazy high fees and big minimum deposits. It just wasn't an option for most people. But then platforms like Robinhood came along and just blew the doors off everything. By getting rid of commissions and account minimums and building these really slick, almost game-like apps, they opened the floodgates like never before.
And if you want to see just how huge that shift was, get a load of this. Back in 2020, almost 3/4 of all new brokerage accounts had less than 10 grand in them. With the old school fees, trading would have been impossible. I mean, this wasn't just a little adjustment. This was a full-on earthquake, a massive flood of a totally new kind of investor into the market.
So what does happen when you suddenly inject millions of new traders, a lot of them without years of experience, into the market? Well, you start to see these really powerful, really predictable psychological patterns bubble up. One of the biggest drivers here is a classic one. It's called herding behavior. Fired up by places like Reddit's Wall Street Bets, you see traders just pile into the same stocks all at once. This creates these huge, coordinated price swings that have almost nothing to do with how the company is actually doing. It's all about pure collective momentum. And what's really wild is how the very design of these apps can crank up our natural human biases. I mean, think about it. You get constant notifications, you see screenshots of other people making a killing. All of that feeds this intense fear of missing out, right? FOMO. And that can easily lead to getting overconfident and making some pretty impulsive decisions. And all that psychology, all that FOMO, it pushes them toward a very, very specific kind of bet. Instead of just buying stocks, many are drawn to these high-risk, high-reward plays. We're talking about cheap, short-term call options that are way out of the money. Now, most of the time, these things expire worthless. Poof, your money's gone. But they offer that tiny, tiny chance of a massive, explosive payout, exactly like buying a lottery ticket. Okay, now we're getting to the absolute heart of it. All of this focus buying, all these lottery ticket options, it has a direct, measurable impact on the market. It's basically creating a secret price hike that's hiding in plain sight. To get this, you need to know about something called implied volatility, or IV. And yeah, the absolute best way to picture this is Uber's surge pricing. We've all been there, right? It's Friday night, everyone wants a ride, and boom, the price shoots up. Well, it's the same deal in the options market. When a ton of people are betting a stock is going to move like crazy, the price of those options, the IV, surges right along with it. And don't just take my word for it. The proof is right here in the numbers. This table compares the median implied volatility for popular retail stocks before and after mobile commission-free trading really blew up around 2018. I mean, just look at GameStop, a mind-blowing 77% jump in the price of its options. And it's not just the meme stocks. Even giants like Apple and Tesla saw a huge surge. This is not random noise, people. This is the direct result of huge demand from retail traders pushing the price of these options way, way up. Okay, but here's the real smoking gun. The final piece of proof is just wow. Researchers noticed something amazing. During those rare times when the big retail trading apps actually had an outage when they went down, that implied volatility, that surge price on these exact same stocks immediately and systematically dropped. Take the retail buyers out of the equation for just a few hours, and the inflation they're causing just vanishes. It's a perfect cause and effect experiment. Now you have to know that this kind of predictable pattern, this consistent price hike, it has not gone unnoticed. The big, sophisticated players on Wall Street, they don't see this as chaos. They see it as a clear, data-driven opportunity. So let's break down the two sides of this coin. It's a totally different ballgame. On one side, you have retail traders, fueled by FOMO and groupthink, who are eagerly buying these overpriced lottery tickets. And on the other side, you have the institutions who are happily selling those very same overpriced options right back to them. One side is buying hope, the other is selling predictability. So, what's the professional's playbook look like? Well, it's actually pretty simple when you break it down. Step 1, they use tools to see which stocks are blowing up on social media. Step 2, they see that inflated surge price, that really high IV. Step 3, they step in and become the seller. They provide all the lottery tickets that the retail crowd is desperate to buy. And then they profit from the gap between the crazy high price they sold it for and what the stock actually does.
So when you take a step back and look at the whole picture, you realize this is bigger than just a few winning or losing trades. The entire structure of the market has evolved, and the playing field is just a lot more complex now.
So that begs the question, right? How is any of this commission-free? Well, it's a system called payment for order flow. Your broker doesn't actually place your trade. They sell your order to a giant market-making firm. And here's the catch. A ton of research shows that everyone in that chain, the broker, the market maker, they make a lot more money when you trade a risky option than when you just buy a simple share of stock. So there's this quiet but very real incentive for them to nudge you towards those exact lottery ticket bets that are causing all these distortions.
And that brings us right back to where we started. There's no doubt that more people can access the market today than at any point in history. But that access has created these hidden costs and new, tricky dynamics. It really forces us to ask a tough question. Are we really seeing the democratization of finance? Or have we just built a much bigger, much flashier casino where the house, ultimately, still holds a very predictable edge?